All right, welcome to Talk Tickers. Today, we're digging into PriceSmart's Q1 2026 earnings report. And the numbers they just put out, they tell a really interesting story. It all kicks off with a bit of a puzzle.
And here it is, the big question. How in the world does a company miss on earnings, and yet the stock jumps over 4%? I mean, on the surface, that makes no sense, right? An earnings miss should be bad news. But PriceSmart's stock closed way up. So what did the market see that the rest of us might have missed in the headline?
So, look at this. It's the paradox right there in black and white. On one hand, they missed their earnings per share target by 6 cents. But on the other, traders just ate it up, pushing the stock up over 4.5%. To figure out why, we've got to dig deeper than just these top-line numbers.
Okay, so first things first, let's get into the official results from the report. This is the raw data that got everyone talking and really drove that initial kind of confusing reaction from the market.
All right, so here are the two big numbers you need to know. First, the GAAP earnings per share, or EPS. It came in at $1.29. The problem? The analysts were expecting $1.35, so that's a miss. But, and this is a really big but, revenue was a different story. They brought in $1.38 billion, which actually beat what everyone was expecting. So right out of the gate, you've got this classic mixed bag, a miss on profit, but a win on sale. But if you listen to the earnings call, management was telling a completely different story. They were pointing to the metrics that, really show the health of the business. Things like net merchandise sales up over 10%, comparable sales up 8%, and look at this, the number of people actually walking through the door and buying stuff up over 8%. The number of members they have, up almost 7%. So what this is screaming is that the core business is actually really, really strong, that EPS miss be damned.
Okay, so let's zoom in on what management actually said on the call. They basically painted this picture of a company that has some serious momentum, just powerful forward motion. But at the same time, they're dealing with some real-world friction that's putting the squeeze on their profits.
And man, the good news was really good. I mean, look at their comparable sales in Colombia. They were absolutely on fire, surging almost 28%. Their digital sales are also booming, growing nearly 30% and now making up over 6.5% of the whole business. Plus, their premium platinum members, that base is growing like crazy, which is a fantastic sign for loyalty and future revenue. And as if that's not enough, they're also planning on opening new clubs and distribution centers. Just pure growth.
But look, they didn't sugarcoat the bad stuff. They were pretty open about the challenges. For one, expenses are going up, and that's putting pressure on their margins. And since they operate in so many different countries, they're always dealing with currency headaches, like having trouble getting their hands on US dollars in Trinidad. They also admitted that some, temporary supply chain problems, and even local stuff like elections in Honduras and bad weather in Panama actually hurt their sales in December. So all of these headwinds, well, that's what explains the pressure on that bottom line earnings number.
Okay, so let's put it all together. You've got this incredible growth story on one side and some very real operational problems on the other. So why did the market seem to only care about the good news? Why did the stock pop?
And this right here, this is the key. Investors essentially decided to weigh the incredible sales growth and the rock-solid durability of their membership model more than they weighed the short-term earnings miss. They saw the headwinds as temporary noise, and they chose to bet on the long-term health and growth of the company. So, here's the verdict on why the stock went up. The market basically heard all that operational noise, the margin pressure, the currency problems, but they were way more impressed by the music of those surging sales and growing membership numbers. They made a bet that management will figure out the short-term stuff because that powerful long-term growth story, it's still completely intact.
So, where does that leave us going forward? What should we expect? Let's get to our outlook for PriceSmart. We'll give you our official call on the stock and tell you exactly what to watch for.
All right, here's our call. The number one thing to watch, the key catalyst, is going to be execution. Plain and simple. Can they get their margins back in line and fix those out-of-stock issues? In terms of the stock price, we see it being pretty range-bound for a bit, but with a definite tilt to the upside as long as that sales growth keeps up. All of this leads us to our official rating, Market Perform. Why? Because the company has to prove it can turn all this amazing demand into clean, predictable profits. So, if you're following the stock, here's your checklist for next quarter. First, watch that margin trajectory very closely. Second, listen for any hint that those supply chain headaches are easing up.
Third, you've got to keep an eye on Colombia to see if that unbelievable momentum can continue. And finally, listen for any news about their big strategic move into Chile. These are the things that are really going to move the needle for the stock going forward.
And that is our breakdown of PriceSmart's very interesting quarter. As always, this is not financial advice.